So last of all, we'll touch on your investment thesis and views on the banks moving forward, Ray. I do have here earnings results from the largest of the four major banks here, being CBA. The Commonwealth Bank reported a net interest income of $18.84 billion, up 1.23% year on year. A full year cash profit of $8.65 billion, up 19.8% year on year. They announced a final dividend of $2 per share, which is going to result in a full year dividend of $3.5 per share. And their net interest margin is 2.03%. And lastly, they have announced an off-market share buyback of $6 billion. So Ray, we've had a quick look at the CBA's headline numbers from their most recent full year result. Can you give us your thoughts on the banks moving forward?
Yeah, no doubt it's been a very strong recovery from the banks overall. What you've started to see in line with the CBA result and the other quarterly updates from the bank is an unwinding of provisions made for bad and doubtful debts. You've seen house prices increase. You've seen lending increase. I know sort of CBA grew its book by about 10% in the result that just went past. And you've seen the banks basically benefit from the Australian Government Term Funding Facility, which helped them improve their net interest margin. So the banks have gone from a worst case scenario where sort of lockdowns and loss of jobs and loss of income potentially see quite a big spike in bad and doubtful debt provisions. And what you typically would see in most recessions is lending collapse, bad debts go up, capital balance sheets get impacted, and banks raise equity. In this last recession, we've seen the banks actually come out much even stronger. You've seen asset quality improve, you've seen net interest margin improve, and you've seen probably a high level of over provisioning that, looking back in sort of hindsight, was quite conservative. The banks have all, with the exception of Westpac, announced pretty significant buybacks. So ANZ $1.5 billion, CBA, as I said, $6 billion, NAB $2.5 billion, Westpac decision pending. And that really sets the scene for how they see their balance sheets in business. They're all in a strong position. They've got excess capital, which they're willing to return to shareholders. They've got strong credit demand being fueled by low interest rates and rising house prices. So for us, the last six months have been a bit of a Goldilocks period for the banks. I think you have to sort of take into consideration that the term funding benefit will be easing because the TFF has basically been halted from the government. And so you are starting to see, increasing competition around mortgages again, which is pressuring their NIM. Term deposit rates are starting to rise. And also the low rate environment benefit has really sort of washed through. So from our perspective, we think sort of the earnings for the banks are going to report sort of moderate earnings growth from here, where you've seen the benefit of provisioning unwound. And so it's probably going to more reflect sort of GDP type growth. And you can see with the dividends, once they start paying out 100% of dividends, they'll be back up to sort of 4.5% type yield, which is still pretty attractive in this environment. But for us, the banks aren't the cheapest aren't the cheapest sector in the market at the moment. So we're underweight CBA, mainly because it's the most expensive bank of all. It's on sort of about 21 times earnings. Arguably, it is the most highest quality with the highest return on equity and highest growth. But also, if you look at sort of the growth with NAB and Westpac, the growth is kind of just a couple of points below sort of CBA. So for us, we're underweight CBA. We've got positions in NAB and Westpac. And overall, we think the growth from here is going to be more dependent on growing the books with some margin pressure and increasing sort of dividends to sort of support the valuations.
What I would take away from the bank earnings and updates was the four major banks are in pretty strong capital positions, and this has led to 3 out of the 4 major banks announcing strong buyback programs. And for example, CBA has announced an off-market buyback of $6 billion. And from my calculations, this represents about 70 million shares they're buying back, and which is about 4% of their current share count. And this is going to unlock value for shareholders. But over the medium term, what I am thinking is the bank's net interest margins are going to continue to be pressured by the yield curve, and the yield curve is going to put downward pressure on the bank's net interest margins. Of the four major banks, what I would say is the CBA continues to trade the most expensive out of the four major banks, in my view. I've got here that CBA reported a book value of $44.37, which results in CBA currently trading at 2.3 times book value. And this is more expensive than the other three major banks, which are all trading about 1.5 times book value. So you are paying more through CBA at the moment.